Right, Jason Katz, the aforementioned, is with me this morning. It is a key question that a lot of investors are asking. Are we reaching an AI bubble?
So I know we have PTSD from back in the dot-com era. Yeah. And so when we see one sector have a parabolic rise, it's hard not to evoke those memories. But there's a fundamental difference of what's going on right now. Back then, the whole surge was fueled by debt and a retail IPO frenzy. The capital expenditures in AI today are happening from the largest, best capitalized fortress balance sheet tech companies in the world. That said, we're getting to the point where we need to walk the walk. You saw the reaction Meta had last week in terms of their capital expenditures. So what the market is actually saying is if you are somebody that provides AI services and hardware, show us a path to return on investment. And if you're a company spending on AI, there needs to be a justification for that spend. We want to see the path to profitability there. Now, I think both of those scenarios come to fruition. And look, we're going to get a correction in AI. We will. But the difference is because we're not over-levered, this is not going to be a systemic problem when we get a garden variety correction.
Look, the money's coming from the people who've already got it.
Exactly.
Big tech. They've got $1 trillion of cash. Okay. Now, you say that we're going to hit 7,300 on the S&P 500 by the middle of next year. That would be about 400 odd points above where it is now. Make your case.
So if you look historically, when there's no recession since 1970, the market's returned around 12% a year. If you add in no recession plus rate cuts, it's averaged 15% a year. Now, you don't want to drive through life always looking through the rearview mirror. What do we see in front of us? We see deregulation leading to deal activity. Big merger announced today with Kenvue and Kimberly-Clark. You see the path of direction in interest rates going lower. And above all, you see productivity gains, not just from AI, from all the technology we invested in the last 20 years. That's why earnings keep on beating expectations. As long as earnings keep on growing, we are going to hold in here. We may not go up 20%. Our target's 7% higher from here. I think that's a reasonable expectation.
Doable. All right, Jason Katz, thanks for joining us. We appreciate it.